Some of the latest readings that we're getting for first quarter GDP growth there. The price index came in a bit softer, rising 3% versus the 3.1% that was expected as part of that report. Now, this is coming as consumers continue to pull back on spending on goods in certain areas. So what does this mean for the overall inflation picture? We've got a good friend of the show, Stephanie Roth, Wolfe Research Chief Economist, here live in living color. Stephanie, good to see you here this morning.
Good to be here.
Okay, so let's just get your read on this, kind of broad strokes from the GDP revision. This is the second revision that we've got. There's still a third that's later to come. But what is your read here?
Yeah, so what we got today is we learned that consumption came in lower than what was initially anticipated. The market kind of knew that. It just was even a little bit slower than that. And that all came largely from durable goods. So that's also tied to this whole interest rate perspective, is that rates are actually starting to have an impact across parts of the economy. And that's what they're supposed to be doing. So our base case is that the Fed's gonna be able to start easing financial conditions later towards this year, because we are starting to see an impact from higher rates. The economy's starting to cool down. Meanwhile, it's still healthy. We're not expecting a recession. We expect that the Fed can be nimble here. And if they start to see real signs of weakness, we start to see inflation coming back down towards the Fed's target, the Fed can be cutting by September.
But how much improvement do they need to see in order to feel comfortable with cutting?
So our base case is you'll probably need to see a trend of 3 prints that are in line with their expectations. Something like, and we're watching core PCE here, which is in part the data that we got today. We're going to get more information tomorrow because we're going to get the April read. Today we just got data through March. We need to see core PCE trending something close to 0.2% month on month. Tomorrow we'll probably see something like 0.25%. That's a little bit high, but definitely better than what we've seen in the past couple of months. And what we'll need to see going forward is something like 0.2% for at least 2 more months in order for the Fed to feel comfortable cutting rates in September.
You've been tracking the same way we have, especially with the fresh reading on the housing market that we got here today, how the Fed is looking into all of this too, and where they're going to be looking across all of the homeowners equivalent rents, where people are still paying either higher rents or more elevated rents historically versus paying to buy a home right now. What is their evaluation from your purview, and how that is kind of continuing to be an outsized impact here on the inflationary picture?
Yeah, so affordability is a problem, right? That's what we're seeing today, is that people in terms of pending home sales being so weak, it's really hard for people to go out and buy a house and trade a mortgage rate that's 3.5% for something that's close to 7%. Like, that trade just doesn't make sense. And until rates come down, it's just going to be unattractive. And by down, I mean something like 50 to 75 basis points lower would probably spur a decent amount of demand. And we saw signs of that earlier this year when rates had actually fallen at least a little bit heading into 2024. You started to see a little bit more demand. And our base case is you need to see something like that in order to make people feel a little bit more comfortable in terms of buying. As for rent inflation, it's kind of interesting because OER is still a problem in the CPI basket. But real-time measures of rent inflation have actually started to cool down. And the Fed has talked about this quite a bit, that they're looking at market rents as opposed to what's measured in CPI, which is a really lagged measure. So rent inflation has actually cooled quite a bit. The thing is, we're talking about level versus rate of change here, right? So the prices are not going to fall in the economy, generally speaking. That doesn't happen unless you have a recession. So our base case is you're not going to have actual falling prices of rents. But if you start to see the inflation rate cool down, that's at least a good thing for what the Fed's looking for.
If we do see a hotter than expected PCE print tomorrow, is that enough to take a rate cut, at least in September, off the table? Or I guess at what point does that kind of change some of the discussions surrounding that first rate cut?
It's going to be really hard to get a big surprise tomorrow. So the Fed is tracking somewhere between 24 and 26 basis points on core PCE. We're looking for 0.25%. To get an actual beat, which would mean you need to get something that rounds up to a 0.4%, you would need a massive, like that to me would be incredibly surprising. So sure, that would take a potential September cut off the table, but the odds of that are fairly low. It's likely that the number will round to 0.3%, or even if you get a little bit lucky, 0.2%.
And then after we get the first cut from the Fed, what does that pacing look like from there on out?
Probably once a quarter. They're not in a rush. They'll probably do a couple cuts. The challenge is, of course, then you have a potential new administration for next year, in which case that could put the Fed on hold for a little while. So base case is they'll get 2 cuts under their belt, perhaps a third. And then it will depend on the outcome of the election and how things are shaping up. For example, if Trump is in office and he starts talking about tariff policy right away, it would make sense for the Fed to pause and kind of see how things shake out.
Do you expect to see any further weakening within the labor market when you take a look at the jobless claims numbers that were out this morning, essentially in line with expectations? The labor market has been so resilient. up until this point. Are we going to see maybe a bit more signs of softness as we do near that first cut?
Yeah, so we just put out our payrolls forecast this morning. We're looking for 165,000 on NFP. Consensus is looking for 180. So a little bit softer than expected, but 165 by historical standards is very good. So no, I don't expect to see material weakness, but we should start to see a softening in demand. Over the past year, job gains have averaged well over 200,000. I think those days are probably over. And we'll be looking for something that's more in the 100,000 on average over the next couple of months, which is a healthy but more rebalanced type of labor market. So we haven't really seen signs of significant weakness in the labor market. I don't necessarily anticipate that to be the case, but it should start to soften, which should help bring rates back down and the Fed cuts kind of at play. So the hawkish narrative that's in the market right now should probably reverse over the next couple of months.
All right, Stephanie Roth, always great to talk to you. Thanks so much for joining us here this morning. Wolfe Research, a chief economist. Thanks, Stephanie.